Good evening, students. I hope you have revised the lecture. Can anybody quickly revise it for me, what we have discussed in the last class? Any student? Can you revise, please?
मैम पूरा पहले से पीजीबीपी समझाना है या सिर्फ लास्ट क्लास का मैम?
जो हमने लास्ट क्लास में किया था.
ओके.
Yeah.
In last class, ICDS 2, we have started with ICDS 2 inventory valuation. Valuation should be lower of the cost or NRV. Cost of the purchases, freight charges, duties, and taxes will be added, and trade discounts and rebates will be reduced from that. Then again, cost of services and cost of conversion. Variable cost will be per unit cost, and fixed cost will be dividing by normal capacity, and we will be include the normal loss. We will not consider the abnormal losses into that. If there are any scrap or byproducts, then we will be evaluate by NRV, and we will be reducing it from the main product. We will follow FIFO method or weighted average method. LIFO method is not allowed. Exception here it is in case of dissolution of a partnership firm, it should be calculated, inventory should be valued at NRV. Then we have gone to ICDS 8, securities held as stock in trade. Interest dividends on securities, these are covered in ICDS 4, so it will not be covered here. Mutual funds, insurance, bank, ventures, these have some separate constitution, so we'll be following them. Here, securities, it will be recognized on the actual cost, cost of purchase price, brokerage, cess, tax, duties. The difference for capital asset, capital gain, and here stock in trade is that in capital gains, tax is not allowed, security transaction tax is not allowed. And in case of security acquired in exchange for another security or asset, cost will be fair value of the security acquired. Again, interest accrued on the security, pre-acquisition interest, we have to reduce it from the cost when we have got the interest from the party company. And closing stock should be valued at lower of the actual cost or NRV. Valuation is based on the category wise and not individual security wise. Categories are shares, debentures, convertible securities, any other securities. For unlisted securities or unquoted securities, measure will be measure valued at cost. Then carried on by the SSC, uh, any act done by the agent will be included uh, in the principal, what we say, principal business. Agent should be an independent agent. He should not be, or not, agent should not be an independent agent. If he is a dependent agent only. And then we have seen that during the previous year, any provisions will not be allowed until and unless followed by the ICDS 10. So provision principle of conservatism we will be following. Prior period expenses and provisions are future expenses which will not be allowed during the previous year. Provision shall be recognized if there are present obligation arising out of the past event. There is a reasonable certainty that there will be outflow of resources from the company, from the SSC to settle the obligation, and a reliable estimate can be made for the amount of the obligation. Provision for warranty, example is provision for warranty because it is based on actuary valuation based on some scientific evidences. Provisions for doubtful debts and gratuity are not allowed because these are not based on the actuary valuation thing. Then liabilities in future is not recognized on certain uncertainty because they are uncertain. Exception 43B only allowed that is on payment basis, and 40A1 TDS whenever TDS is failed and whenever TDS is filed, then only will be allowing that. Then contingent liability probably possible obligation because of the past event depends upon one or more future events. And contingent asset also, we will not be recognizing contingent asset and contingent liability. We'll be disclosing in the financial statements. Then at any time, it is an accrual principle. If business is discontinued, then as per section 176(3) and 176(4) for business and corporation, will be recognized those receipts in the previous year which we have received those amount. Then we have gone to section 28 to sterilization of profit making apparatus because these are capital receipts specifically made to add. Capital receipts are added only when they are specifically given in the act. Compensation in connection with the termination, modification of terms and conditions of the contract relating to management of Indian company, foreign company, government or government company, agency or any business contract. Supreme Court in Saurashtra cement case, the liquidation charges damages due to the delay in the supply of plant and machinery. Uh, Supreme Court has given that it is a capital receipt, so it will not be charged. But because of this section 28 to now it will be chargeable under PGBT income. Next, then we have seen section 28.3 trade of professional association principle of mutuality. One cannot make profit from one own self. So surplus funds, any surplus from the general services provided to a member, not chargeable to the tax. Here we should keep in mind that it is not an exception. It is we should write not chargeable to the tax. Based on principle of mutuality. This is for the benefits of the more own members and identification between the contributors and participants should be there. If there is no identification between contributors and participants or beneficiary, then principle of mutuality will not be applicable over there. Then we have seen a case study, Secunderabad Club, interest received on fixed deposit from members' bank. Not this is not governed by the principle of mutuality because there is no identification between the contributory and the participants. Because there is a tint of business because bank will be lending that money to some another persons and the bank will give less money on the deposits and will charge more money on the loans given. So there is a business also tint, and there is no difference. There is difference between contributory and participants. So general services to the member applicable to trade and professional associations only, not applicable to cooperative societies. Any surplus for general services to the members is not chargeable to tax on the basis of the principle of mutuality. Deficiency, section 44A. Deficiency expense is greater than the income. Expenses other than deductible expense and capex arisen on account of mutuality allow as deduction against any other PGBP income or any other head of income. It is restricted only to the half of the total income. Section 28, income from specific services by trade professional association, not applicable to cooperative society. So only the specific services that are provided by the trade or professional association will be chargeable to the tax. Example, renting of hall to the members for party. And section 44A is not applicable to section 28.3. Then we have seen 28.3A sale of license granted under import export cash assistance duty drawback passbook scheme duty free. Then 28.4 section uh, any benefit perquisite arising from business or profession, whether in cash or in kind, whether convertible to in cash or not. Uh, Along with this, we have to look out section 41(1), which says that if you are allowed claiming any deduction or expenditure before, then only any receipt is there, then we will be looking into 41(1). Otherwise, it will be chargeable in under section 28(4) as a perquisite. So loan is waived, so it will be perquisite. Interest on the loan, if that is waived, since we are taking claiming deduction expense of that, it will be charged under section 41(1). Subsidiary capital receipt for infrastructure development act will be taxable here under section 28(4). If it is in a revenue receipt, then it will anyhow chargeable under section 224. And if the capital receipt it is there, it related to the capital asset, then it will be reduced from the cost of the asset as per the section 43(1) and ICDS 7. Then we have seen TDS under section 194R at 10% if the value of the perquisite is greater than rupees 20,000. Not applicable to individual and HUF whose business or total sales gross revenue is less than 1 CR, a profession whose gross receipts is less than 50 lakhs. Cash discount, sales discounts, rebates, we will not deduct any TDS on it. These are perquisites, but notification, notification,
It is
ma'am,
circular.
what? Circular. It is CBDT circular. It is taken out of the TDS. Medical samples distributed by the distributed to medicos, doctors. It is a perquisite under 28(4), and TDS is applicable in the hands of the pharmaceutical companies. Deduction is also not allowed under section 37, and pharmaceutical company has to deduct TDS under section 194R. In the hands of the hospital, if the doctor is employed to the employee of the hospital, pharma company will be deducting 194 on the hospital, and hospital will be deducting perquisite under section, since employee perquisite under section 192. If a doctor is not an employee, then deduction will be under section 194R, and hospital will be claiming the deduction on that expenses, and it will be booking income under 194R. It will be income for the business. Product given to social media influencers, if it is given back again, then it is not an perquisite. If it is written by the influencer, then TDS under section 194R. Out of pocket expenses, if invoice is on the name of the client and payment is made by the consultant, and later it is reimbursed by the client, then it is not perquisite. If invoice is name on the consultant and reimbursement is made by the client, then it is perquisite and TDS under section 194R. Dealer conference, if for explaining the product, it is not perquisite. To provide incentives to the selected dealers for achieving the target leisure trips, then it is a perquisite under section 28.
Yeah. And even if the leisure trip is incidental, like if they are, going for 1 or 2 days for holiday also along with that, then also it's a perk visit. Fine. Very good. So with this, we'll proceed further. Now, first we'll write down about section 41.1. Okay. Because we have not written it for that. We have discussed 41.1 already. So since it's linked to 28.4 itself, we'll write down about that. So let us write down about section 41.1. What is section 41? Deemed income. Okay. What does section 41.1 says? Where a deduction has been claimed. So what are the conditions? Where a deduction is claimed. This is very, very important. Okay. A deduction is claimed. Deduction is claimed in respect of loss, expense, or the trading liability. Loss, expense, or trading liability incurred by the assessee. Then, in the subsequent previous year, the person has obtained the waiver. Okay. So, in subsequent previous year, there is waiver or remission or cessation. Or you can write like this. There is benefit arising. There is benefit arising due to remission or cessation. Right? So the person has incurred and claim the deduction of the loss, expenditure, or the trading liability. And subsequently, during any previous year, the person has obtained any benefit, right, in respect of such trading liability by way of remission or cessation thereof, right? Then the amount which is the benefit, the value of benefit accruing to him will be deemed to be the profit or gains of business or profession, right? So this benefit shall be deemed to be PGBP. Benefit shall be deemed to be the PGBP of that year in which the benefit has been obtained. Are we clear? Yes or no? Fine, clear this one? Secondly, there is one more point over here. Let's say, for example, there is succession of the business. There is a succession of business. What do we mean by succession of the business?
सोल प्रोप्राइटर कोई दूसरा प्रोप्राइटर टेक ओवर कर रहा है या फिर एमालगमेशन डीमर्जर.
Correct. So succession means basically what? That the business is now being carried on by some different person. Right? Now, in that particular case, let's say the predecessor has claimed the expenses. Right? So there is a possibility that the predecessor has claimed the deduction, right, of, let's say, the expense. Now, whether the successor will be able to, and there is benefit is obtained by the successor, due to waiver of the expense payable, right? So in that particular case, will it be deemed income of successor? Will it be the deemed income of the successor? What
Yes,
does
ma'am.
section 41(1) says? Yes, the successor, if he has obtained the benefit in respect of loss, expenditure, which was incurred by the predecessor, right? So in that particular case, the amount of benefit which is obtained by the successor shall be deemed to be the business income of the successor. Are we clear? So this will be the deemed income of the successor. Yes. Clear? Okay, so this you will remember. Now, the loss or expenditure or any trading liability, when it is like there is a remission or there is cessation, it can be even by a unilateral act by the person, right? So if I'm just writing it off in my books of accounts that this liability is now not to be paid, so in that particular case, even if the other person has accepted that or not, if I get this benefit, this will be chargeable under 41. So this can be even by a unilateral act. Are we clear? So in case of successor, the successor's income will be counted. Succession here means amalgamation, carrying of the business by one person. It was carried out, now it is carried by another person, or the succession of the partnership firm, or if there is a demerger, right? Clear? So this is about the 41(1). Okay. Now again coming back to 28. So we have just still done 28(4). Okay. Now the last few provisions of the 28, let me share the screen. Okay. Now 28.5 is any interest, salary, bonus, commission, remuneration by whatever name called due to or received by a partner of a firm from such firm. So this is specifically chargeable to tax. 28.5 says interest, remuneration, salary, bonus, right? Commission, to the partner, right? From the firm. This is specifically chargeable under 28.5 as PGBP. This is to avoid the confusion whether the partner's income is, let's say, will be chargeable under the head salary or will be chargeable under the head PGBP. So they are specifically clarifying this is chargeable under the head PGBP. Are we clear? Now, what about the partnership profits? What about the profits from partnership?
It is exempted in the hands of the partners.
Correct. This is exempt under, we had discussed that day, 10 to A. Are we clear? This is exempt under section 10 to A. Clear? That day we had discussed under the exemption, right? Now, what does the explanation or the proviso here says? Provided that where any interest, salary, bonus, commission or remuneration by whatever name call or any part thereof has not been allowed to be deducted under section 40B, the income under this clause shall be adjusted to the extent of the amount not so allowed to be deducted. What does this mean? So this interest, remuneration, salary, commission to the partner from the firm is chargeable under 28.5. However, in the books of the firm, right, in the hands of the firm, this is allowed as the deduction, subject to the limits under section 40B. Subject to the limits under section 40B, right? So under 40B, what are the limits? For interest, it is 12%. For remuneration, again, it is subject to the limits of the book profit. Now, if let's say the partnership has claimed the excess deduction, so it will be disallowed in the hands of the partnership firm. Now, if it is disallowed in the hands of the partnership firm, and here also it is chargeable in the hands of the partner, there is double taxation, isn't it? So to avoid that, what they are saying is that if this interest remuneration is, let's say, disallowed in the hands of the firm, this is again not chargeable in the hands of partner. So if it gets disallowed in the hands of the firm subject to 40B, then the excess amount will also not be chargeable in the hands of the partner, so that there is no double taxation. So only to the extent of deduction allowed in the hands of the firm, only that much is going to be taxed in the hands of the. Are we clear about this, students? Yes? Okay. Next is 28.5A. Okay, one more thing before we move to 28.5A, 28.5. Again, there is a TDS which is now applicable on this. 194T. Payment to partners of the firm. What does it say? Any person being a firm responsible for paying any sum in the nature of salary, remuneration, commission, bonus or interest to a partner of the firm shall at the time of credit of such sum to the account of the partner, including to its capital account, or at the time of payment thereof, whichever is earlier, shall deduct the income tax at the rate of 10%. No reduction shall be made where the sum or aggregate of such sum credited or paid or likely to be credited or paid to the partner of the firm does not exceed rupees 20,000 in the financial year. Are we clear? So there is TDS under section 194T, 10% over 20,000 rupees. 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 payment or credit of rupees 20,000. Clear, students? Yes? Is this clear? Yes or no?
Yes, yes,
Okay.
clear.
Yes, ma'am.
Let's go back to 28. 28.5a. Any sum, whether received or receivable in cash or kind, under an agreement for not carrying out any activity in relation to any business or profession. What is this called in simpler words?
Non-compete fees.
Correct, non-compete fee. Not sharing any know-how, patent, copyright, trademark, license, franchise, or any other business or commercial right of similar nature, or information or technique likely to assist in the manufacture or processing of goods or provision of services. So, what they are trying to say over here is that any non-compete fee or any non-sharing arrangement of the know-how or any trade, this intangible assets, right? That is usually a capital receipt. Now, capital receipts are not chargeable to tax, but here they are specifically providing that this shall be chargeable to tax. Are we clear? But this will not include any sum which is received on account of transfer of the right to manufacture, produce, or process any article or thing, or right to carry on any business or profession which is chargeable under the head capital gain. Because if it is a transfer of a capital asset, so if there is a right to manufacture, right, it is any capital asset is what? Capital asset is defined under 214 as property of any kind. Property means what? Property is the bundle of rights. So any right to manufacture can be regarded as a capital asset. So if it is regarded as a capital asset, it will be chargeable under the capital gain and not over here. So therefore, they are excluding from this any right to manufacture, right to produce, any kind of right to carry on the business which is regarded as a capital asset will not be chargeable over here. Fine. So just write down 28 5A, non-compete fees or non-compete fees or amount received for not sharing know-how or intangible assets. Does not include transfer of right to manufacture, produce, or right to carry any business or profession as it is capital asset. Are we clear, students? Yes. So this will be specifically chargeable to tax under section 28(5)(a). This is going to be specifically chargeable to tax under 28(5)(a). This is a capital receipt, usually not chargeable to tax, but here they are saying that this will be specifically chargeable to tax, and if the law says so, then in that particular case, you have to charge it to tax. Clear? Any questions so far, students? Yes? Any doubt? Any question?
I have a doubt regarding this remission or cessation. What do we understand by this in the
Well,
context of
basically, remission or cessation is now that you don't have to pay anything per se to me. It's just like waiver.
Okay.
The liability ceased to exist.
Okay. Okay.
Fine?
Fine. Fine. Thank you.
Okay. Now, next is any sum received under a Keyman insurance policy, including the sum allocated by way of bonus on such policy. 28.6. 28.6 is sum received on the Keyman insurance policy. Right? So this is specifically again taxable under 28.6. Now tell me, this is also present under the head salary. So if you look at section 17, this also talks about the Keyman insurance policy. Let me search it for you. Yeah. So if you look at profit in lieu of salary, it says any payment which is there due to be received from the employer or former employer to the extent to which it does not consist of the contribution of the assessee or interest on such contribution or any sum received under Keyman insurance policy. So when it will be chargeable under 17 and when it will be chargeable under 28.6?
If it is received in the capacity of an employer, then under 28.6. If it is received like a normal individual, then under salary.
So if it is received, no. If it is received by the employee, not normal individual. If I am receiving it as an employee, then under section 17. Right? So then it will be taxable under section 17.3. So if I receive it as an employee, it is under 17.3. If I receive it in the exercise of the business or profession, then it is under 28.6. Now, if you see, it is also present under 56. So if you go to 56, there also you will find the Keyman insurance policy. Then in that particular case, which one will be covered under PGBP? Sorry,
Third
IFOS.
person. Third
Yes,
person.
correct.
Any
Third person.
third person.
So if my family receives it, I have died, my family is receiving it, then in that particular case, it will be chargeable under their income from other source. So if it is received, let's say by the family, then it will be chargeable under section 56(2). Are we getting this? So it is very, very important, students, that we categorize it under the proper head of income. If we do not categorize it under the proper head of income, you may tend to lose out on deductions or you may claim the wrong deductions. Are we getting this particular point? So if you are getting it as an employee, then you will claim under 17.3. If you're getting it as a businessman, then 28.6. And if it is not chargeable under that PGBP or under the head salary, then in that particular case, it will be covered under the IFOS. Are we clear? Yes, any questions, any doubt? Fine? Okay, yes or no?
Yes, ma'am.
Yes,
Okay.
okay.
So, in this particular case, here I will receive it under the, if I'm receiving as a family member, then it will be taxable under the head income from other sources. Next one is 28. Again, let's go back to 28. Yes. The fair market value of the inventory as on the date on which it is converted into or treated as a capital asset determined in the prescribed manner. So, what is 28.6? Just here write down salary. This is IFOS and this is PGBP. Okay, now 28.6A. Conversion of what it is? The conversion of the stock in trade into a capital asset. Conversion of stock in trade into the capital asset. So when the stock in trade is converted into capital asset, what is 28.6 is saying? That the fair market value of the inventory as on the date of conversion will be considered as the PGBP. So here what will be my PGBP? FMV as on the date of the conversion. FMV as on the date of the conversion. Now what will be my FMV? So it says in the manner it is prescribed. So where it is usually prescribed?
Rules.
Yes, they will prescribe it into the rules, right? So what does the rule say? Rule says that in case the stock in trade is basically the immovable property. If my stock in trade is the immovable property, then it will be stamp duty value. In case it is any other asset, then it will be considered as the market value. Are we clear? So just write down. So this will be for immovable property. This will be my stamp duty value. And in case of the other, this will be my market value. Right? Now FMV as on the date of the conversion will be considered as PGBP. So will I get any deduction? Yes, you will still get the deduction for the cost of purchase. Right? You will still get the deduction for the cost of the purchase. That is not a problem. Right? So here you will get all the deductions that you have incurred any expenditure also on this stock you will get. So FMV minus date of conversion minus the cost. Right? Now when you sell this stock in trade, when you sell this capital asset, under which head the income will be chargeable? Capital gain.
Capital gain.
Correct? Now what will be the cost of this capital asset?
FMV on the date of conversion.
Correct. Because this FMV is already taxed over here, I will claim this as the cost of the capital asset. This is as per section 49. This is as per section 49 of the Income Tax Act, which says that FMV as on the date of conversion will be considered as the cost of capital asset. Clear? Now, if let's say I'm not selling the stock, if I'm not selling the capital asset, I'm using this capital asset for my business. Then in that particular case, the cost of the capital asset for the purpose of the depreciation will be the FMV, which is taxed over here. Right? This is again as per section 43. Are we getting this particular point, students? So even if you're not selling the capital asset, but you are using it for your business, it will be considered as the FMV only. The cost of the capital asset for the purpose of depreciation will be FMV as on the date of conversion, which is charged under 2860. So it's a classic case. Let's say, for example, I have a land. Right? Or I have the buildings. I'm a builder. I have the buildings, right? Or I have the flats which are there. Now, these flats which are there, there are some unsold flats which are there. Now, I think if it's not, being sellable, let me use it for my own office. This is the case of conversion of stock in trade into capital asset. I'm making a very simple statement by saying, okay, I had some unsold flats. I'm a builder. And now I'm going to use one of those flats for the purpose of my office only. Very simple statement. This kind of statement may be given in the exam. You have to apply your mind that if this is there, it was a stock. And now if he is going to use it for his business, this will become his capital asset. So what I should be doing is, I should be taxing under 28(6)(a) the FMV of that particular flat. And then if he is going to use it for his business, I will also be eligible to claim the depreciation FMV now. Are you getting this particular point, students? So there may be a simple statement given in the exam. They will not say that this is converted into stock in trade. You have to understand and apply, oh, this is converted into stock in trade. Are we clear? Yes or no? Okay?
Yes,
Yes.
clear.
Okay. Last one is 28(7), which is any sum whether or received or receivable in cash or kind on account of any capital asset other than land, goodwill or financial instrument being demolished, destroyed, discarded or transferred if the whole of the expenditure on such capital asset has been allowed as a deduction under section 35AD. This, I'm not doing it at this point in time. When we will go to 35AD, at that point, we'll come back to 28(7). I'm not going to discuss here at this point. Fine. Explanation 2 says where speculative transactions carried on by assessee are of such a nature as to constitute the business shall be deemed to be a distinct and separate from any other business, hereinafter referred to as speculation business. We have already done the speculation business, right? So that is done. Explanation is, it is hereby clarified that any income from letting out of a residential house or part of a house by the owner shall be not chargeable under that PGBT and shall be chargeable under that income from house property. What was the reference that we discussed for? Which case law is over?
Chennai property. Chennai property.
But in which cases still you will charge it under PGBP?
Commercial property.
Correct. If you are into the business of letting out of commercial property, you can still charge under the PGBP. If it is residential, then even if it is your business, you will go to the house property. Are we clear? Yes or no? What is a speculation business, student?
Transaction in which contract for purchase or sale of commodity, stock or security settled otherwise in the otherwise actual delivery.
Actual delivery. Correct. And what is not speculative is the derivatives, even if for hedging or for the purposes of the, yes, hedging or speculation. Correct. So even if it is for hedging, even if it is not for hedging, in those cases, future forwards, your options, everything will be not speculative. What will also not be speculative if the principal business of the company, right? If the principal business of the company is to purchase and sell the shares or of the other company, it will be speculative. However, if in that particular case it has majority of the income under the head IFHP, if it is at majority of the income under the capital gain, under the this income from house property, then in those particular cases it will not be regarded as the speculative income. Right? Or where the principal business of the company is trading in shares, banking or granting of the loans and advances. In that particular case, it will not be speculative. Clear? So this completes your section 28. Now we are moving towards the next section, which is section 29. What it says, income from profit and gains of business or profession, how computed? So it says the income referred to in 28 shall be computed in accordance with the provisions contained in 30 to 43D. So you have to follow 30 to 43D to compute the profits. Now, let me give you a presentation. So how will you start here is, so section, for the purposes of section 29, you will start with your net profit as per the profit and loss account, right? Profit and gains means as per the commercial principles of the accounting, right? You will make any adjustments with respects to ICDS 1 to 10. Add or less, right? You will add any disallowance of the expenditure. This is how your presentation should be. Either under section 30, 31, or for the purposes of your 36, 40, right? So all of those sections you will do it. Less any expense allowable, right? You will add here any income which is deemed income basically. For example, section 41, right? Then you will less any income chargeable under any other head, right? So this is how you will compute your PGBP. Are we clear, students? Fine? Okay.
Yes, ma'am.
Now let's move on to the specific sections over here. First is section 30. Rent, rates, taxes, repairs and insurance for the building. Section 30. So, right? So section 30 is talking about rent, rates, repair, insurance and taxes for building. Right? So it says in respect of rent, rates, taxes, repairs, insurance for the premises which are used for the purpose of business or profession, the following deductions shall be allowed. Where the premises are occupied by the assessee as a tenant, rent paid for such premises will be allowed as a deduction. Further, if he has undertaken to bear the cost of the repairs to the premises, the amount paid on account of such repairs will also be allowed as deduction. Otherwise, then as a tenant, he is owning the property, the amount paid by him on account of current repairs to the premises will be allowed as deduction. Right? Any sum paid on account of land revenue, local rates, municipal taxes will be allowed. Any sum of premium paid in respect of insurance against risk of damage or destruction will be allowed. For the removal of doubt, it is hereby declared that the amount paid on the cost of repairs referred to in 1 and the amount paid on account of current repair referred to in 2 shall not include any expenditure in the nature of capital expenditure. Now, this is very, very important. Now, how do you distinguish, students, between the revenue and the capital expenditure? Yes. What is the line of distinction between the capital and the revenue expenditure, students?
If it is for the period of more than 1 year, then it would be the capital, it will be capitalized, otherwise it will be a revenue expenditure.
See, the 1 year threshold is ideally not the correct threshold that is there.
If it increases the benefits available from the asset, then capital. If it maintains the already available benefits, then it is a repair.
Okay. So if it increases the life of the asset, then yes, this could be capital expenditure. If not, this could be the revenue expenditure. Right? So now this distinction is very, very important, students, to determine whether the expenditure is of a capital nature or whether it is of the revenue nature. Because the capital repairs which are there are not allowed as deduction, students. Whereas the revenue repairs which will be there, the current repairs which are there, that is allowed to you as a deduction. Are we getting this particular point? So you have to categorize it into you have to categorize it appropriately, because if you do not categorize it into proper head, it may result in the disallowance. So any expenditure which brings in new asset into existence or give an advantage of the enduring nature, such expense shall be the capital expenditure. Are we clear? So just write down over here. So any expense, so capital repairs are not allowed. Okay. So what is capital expenditure? Any expenditure which brings in new asset or gives an advantage of enduring nature is the capital expense, capex. And this will not be allowed to you as a deduction. Whereas if an expenditure is incurred to facilitate the business operations to be conducted smoothly and does not give rise to benefit for indefinite future, right? Then in that particular case, it is a revenue expenditure. Are we clear? So, where the expenditure is incurred for the smooth performance of the business. For improving the performance of existing business, then it is the revenue expense. So if a new business comes into existence, then it is the capital expense. There is one case law in your module. Okay, now what that case was about is, in that particular case, the assessee had conducted some, the assessee had incurred certain expenditure on the putting up the boards for the advertisement. You know, like there are big billboards which are there at the dealer outlets. Whether this will be the capital expenditure or whether it will be the revenue expenditure. Capital or revenue?
Revenue,
Why is it a revenue? Why is it a capital?
because it is incurred for smooth running of the existing business.
Hmm.
And it may be of enduring nature, that has to be determined by what type of board is that. I don't know.
Yes, anybody thinks it's a capital expenditure? Yes. It will give benefit of enduring nature. See, the court in this particular case had held that any expenditure which is for the glow sign board. Now these glow sign board have a lot of wear and tear. Isn't it, students? They have a lot of wear and tear. Like when the rains will come, obviously they will, like lose their shine. So you will have to get them replaced. You will have to get them painted year on year. So this is not bringing any new asset into existence. Right? This is not going to bring any new asset into existence. This is not going to give you any advantage of the enduring nature. So the court in this case held that the expenditure which is incurred on these glow sign board is revenue in nature. This is not an asset of permanent nature. It has a very short life. It is subject to decay and therefore, further replacement is required year on year. And this is incurred with the object of facilitating the business operation of the assessee and not with respect to acquiring the asset of enduring nature. And therefore, this will not be the capital expenditure. So just write down. Glow sign board. This is the revenue expense as no permanent asset comes in existence, and these are installed for facilitating the business. Now, this could be asked as an adjustment in the examination. So, you will have to write this case if you can remember. Orient Ceramics and Industry case. Okay. There is another case in your module which is with respect to expenditure incurred on performing the feasibility study for examining the technological advancement relating to the existing business. So, the businesses do the feasibility study that whether it is viable to, invest in this technology or not. Whether this is capital expenditure or whether this is revenue expenditure.
Revenue expenditure.
Revenue.
Why revenue?
See, because this has been done in quest of a kind of research type, yet the asset has not came into existence.
So here the new asset has not come into existence. Here this was done to enhance the business. Yes, if the new asset would have come into existence, then obviously that would have altogether. But here the new asset has not. This has been abandoned. This study was abandoned because it was not, found worthwhile to do any more investment into the technology because it didn't give that much, results to the company. So in that particular case, the court in Priya Village Roadshow's case had held that this is a revenue expenditure. So you can just write it over here. Expenditure for feasibility study for understanding technological development. This is revenue as no new asset came into existence. Yes or no? If you remember, we had discussed one case even in the basic concept class. Something like this similarly. Yes. What was the case? Can anybody tell me? Yes, students. So it was in the context of the assessee incurring the expenditure towards the development of the software, but which was abandoned. In that case, it was a Supreme Court case, very recent case of Adadian Technologies. So the assessee had invested in development of the software, but due to some technological updates, it could not be developed. So what did the Supreme Court held in that case? Whether it will be revenue or whether it will be capital expenditure?
Revenue expense.
Yes. Why revenue again?
New asset does not come into existence.
Correct. So in that particular case also, the Supreme Court in Adadian Technologies had held that even if the project was abandoned, even if the project was abandoned, so no new asset had come into the existence, students. No new asset had come into existence, and because of that it will be considered as the revenue expenditure and not the capital expenditure. Are we getting this particular point? So where no new asset is coming into existence, in that particular case you will not consider it as the revenue, you will not consider it as the capital expenditure, you will consider it as the revenue expenditure only. So just write down here again. This is Riya Village Road Shows, right? And next is tech. This is a Supreme Court ruling where expense incurred on the software which was abandoned due to tech update. This is the revenue expense as no new asset comes into existence. There was another case that we had discussed in the first chapter itself, Honda CL Car India Limited. Honda CL Car India Limited. What was that case? Can anybody tell me? Yes. So in that case, the technical fee was paid under the technical collaboration agreement for setting up a joint venture company in India. And this technical know-how was obtained to improvise the existing business. Right? But in that particular case, the collaboration agreement which was there included not only the transfer of technical information but also the entire assistance in respect of establishment of plant and machinery so as to set up a new manufacturing unit in India. So what did the Supreme Court in that case held that this technical fee is a capital expenditure. Why is it a capital expenditure, students?
Setting up of new plant and machinery. So new asset is coming in.
Correct.
So it is capital expenditure.
Correct. It is setting up of the new plant and machinery. And student, one very important thing. See, if the entire this agreement was terminated, right, the entire project would have come into end. The entire project would have come to end. So because of that, they held that this is a capital expenditure and not a revenue expenditure. Are you getting the distinguish basically between the capital and the revenue? This is, students, very, 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 very important. Right? So if it is of such nature which enhances the life of the asset, or which is basically for the purpose of enduring nature advantage or brings into existence some new asset, then in that particular case, it is considered as the capital expenditure. Right? So if it is a significantly improving the performance of the asset, the repair is significantly improving the performance of the asset, then like in that case, it's a capital expenditure. Now, what do we mean by the significant improvement? So the object is that if, let's say, for example, if this machinery has stopped working, now I would have to discard it. Right? It is completely worn out. Now, if I put, let's say, some parts into it, and now it is workable for next 5 years. Let's say my TV is there. It is worn out. It is not, switching on also. But if I change its part, because of which it will be able to work for another 5 years. Whether it will be a current repair or capital repair.
Capital repair.
Correct. So where the assessee is spending money for getting the repairing done, which is going to prolong the life of the asset. Or it is going to increase the asset significantly. And if that asset is a vital part, then it is considered as the capex. Where it's, let's say, for example, I'm fitting some screws into the machinery. It's a revenue expense. It is a current repair. Then you will claim that is as the deduction. Are we clear? So where I'm installing, let's say, some boilers, I'm doing some, some filters I'm replacing, some cylinders I'm replacing, that is a revenue repair. So it is dependent on the facts of each case. Only current repairs are to be allowed and not the capital repair. Okay? So the requirement here is that if it is offering some enduring benefit advantage, it should not be creating some new asset, increasing the life of the new asset. Then in that particular case, it is the capital revenue expenditure. Clear? Yes. So just write down about the Honda CL case also over here. So where the technical collab agreement provided technical assistance for the setting up of new manufacturing facility. This is the capex. This is in the case of Honda CL Supreme Court. Are we clear? Okay. Fine. Now this is section 30. Similar is the section 31. What is 31? 31 is about the furniture. Plant and machinery and furniture. What does 31 says? 31 says in respect of repairs and insurance of machinery, plant or furniture used for the purpose of business, the following deduction shall be allowed. Amount on current repairs, amount of insurance premium. And this current repairs shall not include the expenditure in the nature of capital expenditure. So 30 was with respect to building, which provided for deduction of rent, repairs, insurance, taxes and rates for the building. But in respect of 31, which is for the only providing repairs and the insurance for the plant and machinery or the furniture. Obviously, there can't be any taxes for plant and machinery or furniture. There can't be any rates. There can be rent, but rent is not allowed under 31. Clear? You can claim it as a general deduction under 37 in case you have taken, let's say, ACs on rent or whatever. But under 31, only repairs and insurance are allowed. not allowing the capital repairs. Now in this connection, we will also make a reference to the ICDS again. Okay, let's make a reference to the ICDS 5. What does ICDS 5 says? Tangible fixed assets. ICDS 5 is tangible fixed assets. What does it say? An expenditure that increases the future benefits from the existing asset beyond its previously assessed standard of performance is added to the actual cost, meaning it has to be capitalized. So an expenditure which increases the future benefit from the existing asset beyond its previously assessed standard of performance is added to the actual cost. The cost of an addition or extension to an existing tangible fixed asset which is of a capital nature and which becomes an integral part of the existing tangible fixed asset added to its actual cost. Any addition or extension which has a separate identity and is capable of being used after the existing asset is disposed of shall be treated as separate asset. For example, if inverter is there, you have battery which is there. Battery will be a separate asset because even if the inverter is disposed of, battery can be used separately on some other inverter also. Are we clear? So just write down. ICDS 5 provides if expenditure increases the future benefit from existing asset beyond its previous performance. What you need to do? This needs to be capitalized. Are we clear? Any questions, any doubt till now, students? Yes or no? Okay. So this completes your capital and the revenue expenditure. So we have divided PGBP into different parts. Part 1 was distinguishing between the different heads of income and PGBP. Part 2 was section 28, the chargeability under PGBP. Part 3 was the capital versus revenue expenditures, right? Now we are moving into the part 4, which is very important topic. Yes, which is a very important topic.
Depreciation.
Correct. Very good. Section 30. Yes. So now let us move to section 32. Very, very important. Depreciation. Now, in respect of the depreciation, what is depreciation? Depreciation is allowed on two kinds of asset. One is tangible asset, second is the intangible asset. Right? In respect of the depreciation, in respect of the tangible asset, they say tangible assets they have divided into two categories. Right? They have divided into two categories. One is the depreciation on the building, plant and machinery and the furniture and building, plant and machinery and furniture. Three asset category, which are tangible asset. Second is know-how, patents, copyright, trademark, licenses, franchise or any other business or commercial right of similar nature being intangible acquired after 1998, not including the goodwill of the business or profession. Are we getting it? So tangible assets will include this building, Plant and machinery and furniture. Intangible assets will include these amount but will not include the goodwill of the business or profession. Are we clear? So just let's write down about this. So depreciation under section 32. Tangible assets and second is intangible. Right? What are the tangible assets? Building. Land is not a depreciable asset, right? Plant and machinery and my furniture. What are my intangible assets? Intangible assets are basically know-how, patents, copyright, trademark, licenses, franchisee, or business or commercial rights of similar nature. Know-how, patent, copyright, trademarks, licenses, or franchises or any other business or commercial right. What do we mean by any other business or commercial right? We had learned one principle in the first class to understand these kind of words. What was that? Yes.
Jusum generis.
Correct. Very good. So, what does this mean? That business or commercial right, which is there, this will derive its color from its neighboring words, by its surrounding words, right? So adjustum the generis is basically focusing on the general term belonging to the same category as preceding term. Nociter resources, somebody has written, that is surrounding words. Sandeep, nociter resources is basically for the surrounding word. Adjustum de generis is basically what is the category of the words which is written. From that, you will understand that what is the final word that you are trying to interpret is saying. So any other business or commercial right will include basically some intangible asset only. Maybe like, data, maybe like customer list, maybe supplier list, any other kind of intangible asset. Nociter resources is, let's say I want to interpret this word license, I will use the principle of nociter resources. But I want to interpret this, there is a class of the words which are mentioned and I want to interpret this term, which is a general term which is given. For that, adjustum de generis will be applied. Clear? Now, what is this plant and machinery? What is this plant? Where is it defined? So, there is section 43, which is definition of certain relevant terms to the income from the PGBT. Section 43 is the definition section. Now, here you will see that the term plant will be defined. 43.3 says plant includes the ships, vehicles, books, scientific apparatus and surgical equipment used for the purpose of business or profession, but does not include tea bushes, livestock, building, furniture and fittings. Are we clear? So plant includes here what all is included in the plant? Ships, Then you have vehicles, even books. Then you have scientific apparatus, surgical equipment, and does not include tea, bushes, livestock, or building or furniture or fittings. Are we clear? So this is the meaning of the plant and machinery. Is this clear, students? So that is about section 32. First, on what it is chargeable. On what you will get the eligibility for your depreciation. Which assets are eligible for the depreciation? That's the first part of it. Clear? Now, for claiming the depreciation. For claiming the depreciation, again we'll come back to section 32. What does it say? In respect of depreciation of these assets, tangible and intangible, owned wholly or partly by the assessee and used for the purposes of the business or profession. So students, what are the two conditions? Assets should be owned by the assessee, and secondly, it should be used for the purposes of my business or profession. So these are the two very, very important conditions for the purpose of the depreciation. So for claiming the depreciation, the first condition is asset should be owned by the assessee. And second, the asset should be used for business or profession. These are the two very important conditions which are there under section 32, without which you will not be able to claim the depreciation, students. Very, very, very important. So, first of all, what do we understand by the owned by the assessee? Assessee should be owning the asset. Whether the assessee, when he has taken the building on or flat on rent, whether he will be eligible to claim the depreciation? Yes.
No, ma'am. No,
He
ma'am.
will not be, right? So, first of all, the asset should be of its assessee's own. It cannot be that the assessee has taken the possession on the lease. That is very, very important. Are we getting this particular point?
Yes.
So, when, let's say, for example, I have taken it on lease, I will not be allowed the claim of the depreciation as the lessee. Of course, there is one exception that we are going to discuss in a minute. But what is important here is that I should be the owner of the asset. Now, what if, let's say, for example, the registration is pending, but I have paid the money. So the legal title has not been passed, but owning the asset because I have paid for that particular asset. The legal title is with somebody else. So is legal title important over here? The answer is no. Ownership is important. legal title is not important, students. Be very, very clear about it. What is important is that I should be the owner of the asset. I should have paid for that particular asset. I may not be the legal owner of that particular asset. That is still fine. Okay. So the depreciation which is there is on the asset which is owned by me. Are we clear? So even if I have paid for it and I have not received the legal title of that, in those cases also courts have very well held that this is, even in those cases, the depreciation will be allowed to the assessee. Okay, the depreciation will be allowed to the assessee in that particular case. Yeah. So first thing, assets should be owned by the assessee, and it could even include the beneficial ownership. And even if I have not really had the legal ownership of that, like legal title is pending, in those particular cases also the courts have held that yes, the assessee is still the owner of that particular asset. Clear? Now there are two things which are there, the exception that I was talking to you about. So when I say that the assessee should be owning the asset, this is a precondition for the depreciation. So here, let's say for example, that in cases like, let's say for example, there is, these roads are developed in the public-private partnership, where the roads are owned by the government, but the assessee develops the road. Will the assessee be able to claim the depreciation?
No, ma'am, because there will be no ownership right.
Correct. There is no ownership right. It is developed in public-private partnership. Assessee just has right to receive the toll after development of the road, because he would want to recover its cost, but he will never get the ownership of the road. Are we getting? So in these kind of public-private partnership cases where they are developing it with the government, in those cases they have held that no, the assessee is not the owner, and therefore he will not be able to claim the depreciation in that particular case. Are we getting this particular point? So the assessee should be owner to claim the depreciation. Let's say for example, in case where, let's say, the assessee has paid for, let's say, the vehicle, right? But the Motor Vehicle Act allows you to become the owner of the vehicle even without the registration. So the registration is not in your name. So the assessee has, let's say, purchased some buses, but the buses are not registered in its name. Will he be able to claim the depreciation?
Yes, ma'am.
Yes,
Yes.
will be able to,
Yes,
right?
ma'am.
So in that case, the ownership is still there. So even if I have not registered the vehicle in my name, the depreciation cannot be denied on this account where the registration is not done, provided the assessee is able to exercise the rights of the owner over the vehicle. So beneficial ownership is also an ownership. So depreciation in those cases cannot be refused. So just write it over here. Asset should be owned by the assessee. So even if legal title is not transferred, but the assessee is beneficial owner, he is the owner. So here you can write example, vehicle or buses not registered in the name of assessee. However, if roads are developed by SSC, ownership is with government, then in that case, assessee not entitled to the depreciation. Are we clear? Okay. Is it clear, students? Any question, any doubt?
Clear, ma'am.
Okay. So I think let's take a break over here and then we continue on this topic after 10 minutes. Let's take a break of 10 minutes. owner of the asset. Okay. Now, in case of, let's say, for example, we are talking about the hire purchase, right? So in that case, the CBDT has given a specific clarification. In the case of the hire purchase, the lessee can claim the depreciation if at the end of the hire purchase tenure, the asset is transferred to the assessee. Are we clear? So there is a CBDT circular which says that in case of hire purchase, if at the end of period the lessee will purchase the asset. Because what will happen is when he will pay the hire purchase installments, right? When he will pay the hire purchase installment, in those particular cases, it will be regarded as a purchase price only, right? Because at the end of the period, he will purchase the asset. He is not renting out the asset forever. Are we clear?
मैम,
Yes, Mama? Yes.
सपोज अभी एसेट है वो 2-3 साल तक पेमेंट कर रहा है, राइट?
हाँ.
स्टार्टिंग ऑफ द पीरियड में ये था कि एसेट है वो ट्रांसफर हो जाएगा लेसी के नाम पे, बट ही डिफॉल्टेड इन पेमेंट। तो फिर लास्ट कब तो स्टार्टिंग में उसने डेप्रिसिएशन ले लिया, लेकिन बाद में जाकर जब डिफॉल्ट किया तो एसेट उसके नाम पर ट्रांसफर नहीं हुआ, तो उसे पहले का डेप्रिसिएशन रिवर्स बैक करना पड़ेगा इस साल में या समथिंग?
See, that can also happen when you purchase it on installments, right? Like when you purchase the asset on installment, and if you don't pay the installment, what will happen? They'll take away your asset, isn't it?
यस मैम।
So bank will take away your asset. Like let's say, for example, I've taken this house on loan and I'm not able to repay the installments. What they will take will the asset back. So whatever depreciation I've claimed till the time I've used the asset, that's fine. That is still fine. Okay? It's the same thing. Now, another exception is explanation 1 to section 32. What does it say? Where the business or profession of the assessee is carried on in a building not owned by him. So where the assessee is carrying out its business in a building which is not owned by him, but in respect of which the assessee holds a lease or other right of occupancy. And any capex is incurred by the assessee for the purpose of the business or profession on the construction of any structure or doing of any work in relation to and by way of renovation or extension of or improvement to the building, then the provision of this clause shall apply as if the said structure or the work is a building owned by the assessee. So basically, one of the exception here is, what is the exception that the asset should be owned by the assessee? It is the explanation 1 to section 32, which says that if the assessee is a lessee and has done some capital expenditure, some capital expenditure with respect to the construction of any structure in that building or construction of structure or repair or renovation of the building, right? In that case, the lessee shall be entitled to the depreciation, right? then the lessee shall be entitled to the depreciation on that building because he has done some major structural change or he has done some major repair or renovation of the building. So now even if he is lessee, he will be entitled to claim the depreciation on the building. Are we clear?
Depreciation on the capital expenditure that he has occurred, right? Only on that amount.
No. So if you look at this thing, it says that the lessee shall be entitled to the depreciation, and in that particular case what they say is here, if you look at the wording, the provision of this clause as in 32 shall apply as if the structure or the work is a building owned by the assessee. So in that particular case, the rate of depreciation will be the rate of the depreciation which is applicable on the building, right? But the depreciation will be only available with respect to the amount that the assessee has paid for the repair, renovation, or the construction of that particular building. So obviously on the cost on which I have not paid anything, on that too I will not be able to claim anything, right? So it is only on the amount capital expenditure that I have incurred for the renovation, extension or improvement of the building, I'll be able to claim the expenses. Are we clear?
Yes, ma'am.
Or the extension. So this was the first condition, asset should be owned by the assessee. Second is asset should be used for the business or profession of the assessee. Now what does this mean? That the asset should be used for my business or profession. Right? Asset should be used for my business or profession. Now, obviously, there are, position that, let's say, for example, I have purchased the asset, but I have leased those assets. Will I be able to claim the depreciation? Yes.
If it is my business of lending of the assets, then it will be my income, and we will, since I am the owner also, and I am using it for my business of proportion, I will be claiming depreciation on it.
Correct. So yes, you can claim the depreciation. So basically, where let's say, for example, the asset has not been used particularly for my business, right? But these are owned by me. And if I'm letting them out, then in that particular case, I am still the eligible for that particular, because that letting out is my business, right? So the business should be carried on by me, right? So what is important here is that in case of, let's say, these, transport operators, they hand over the buses to the, third party to run them. Now, obviously, the third party will not be able to claim the depreciation as he is not the owner. But I am the owner, but I'm not using it for my business, these buses. I am just letting them out. So, in those cases, it was held that yes, I am into the letting out of the business. So, in that case, I will allow the depreciation claim. But where I'm not into that business, right? I'm into some different business only. Then I will not be able to claim it. Are we clear? And the use here will include the assets which are ready for use. So passive use is also a use. So if there are some standby equipments which are there, so in that particular case, I will allow the depreciation on that also. Are we clear? Any questions, any doubt? Yes or no?
Clear, ma'am.
Yes,
Okay,
ma'am, clear.
so let's just write it over here. Includes the passive use, right? Which is the standby equipment. Okay, so the two conditions, one is asset should be used and asset should be owned by the assessee. Now let us go further into section 32. Now 32.1 says the following deduction shall be allowed. 32.1 says in the case of assets of an undertaking engaged in generation and distribution of the power, such percentage on the actual cost thereof to the assessee as may be prescribed. So basically, here what we are going to talk about is the first under 32. There are two kinds of depreciation. First is for the power generating or generating and the distributing companies. This is on the SLM basis. Section 32.1.1. And then we have under 32.1.2, in the case of any block assets, such percentage on the written down value as may be prescribed. So second concept is depreciation on block of asset, which is section 32.1.2. Are we clear? So the first one is for the power generating units or the power generating companies which are there. Now 32.1.1 provides for the depreciation to the power generating units on the SLM basis. This is on the SLM basis, students. Now this is an optional scheme for them. This is an optional scheme for them. This is not a mandatory one. It is not that these power generating units have to claim the depreciation in the case of on the SLM basis only. This is not at all mandatory, students. Are we clear? Now, as may be prescribed, where it will be prescribed?
Rules.
Correct. It will be prescribed in the rules. So, the rules prescribed for the depreciation methodology, the rates of the depreciation, all are prescribed under the rules. So in the case of the power generating units and in case of the others also, the rule 5 of the income tax rules provides for the depreciation. So what it says is, if I take you to the rules, it says the undertaking specified in 32.1.1 may, instead of the depreciation specified in Appendix 1A, at its option, be allowed the depreciation under Subrule 1 read with Appendix 1. If such option is exercised before the due date for furnishing the return of income under 139.1. And once this option is exercised, shall be final and shall apply to all the subsequent years. Are we clear? So this is basically the optional scheme. However, once exercised, option cannot be changed. And the depreciation rates are given under the Appendix 1. So 1 and 1A are there for the depreciation rates. So if you see this, Appendix 1. Okay. So this is for the depreciation under Appendix 1, and you have Appendix 1A, which is also giving the rates in respect of the power generating units. Are we clear? So this is for the power generating units. These rates are given on the SLM basis. So depreciation allowance as a percentage of actual cost. Clear? Yes or no? Now, in the case of the power generating unit, students, this is, as I said, the optional scheme. You have to exercise the option before the due date under 139(1). Now, let's say, for example, if the asset is demolished or transferred or destroyed. So let's get to 32(1)(3). It says, in the case of any building, machinery, plant or furniture in respect of which depreciation is claimed and allowed under clause 1. Basically where we are claiming the SLM depreciation for the power generating unit. And which is sold, discarded, demolished or destroyed in the previous year. So, here you can just write exercise before 139(1) due date. Okay. So now where the asset is destroyed, demolished or the transferred. Okay, is sold, discarded, demolished or destroyed in the previous year. The amount by which the money payable in respect of the asset together with the amount of scrap value, if any, fall short of the written down value thereof. Such deficiency is actually written off in the books of the assessee. So what it is saying is, if my sale consideration is less than the WDV, if my sale consideration is less than the WDV, so in that particular case, there will be the difference between the two will be allowed under 32(1)(3) as the terminal depreciation. Are we clear? But what if my, let's say for example, if my 100 was the actual cost. Let's say my depreciation was 30, right, till now. So 70 is my WDV, right? And let's say my sale consideration was 60, which is less than 70. So 10 will be allowed as terminal depreciation. Now let's say for example, if my sale consideration is greater than the WDV, right? In first instance, let's say my sale consideration is 120. I don't know why is it creating problem. Yeah. Let's say my sale consideration is 120. Let's say my sale consideration has exceeded the WDV. Right? Now, if my, or let's suppose we are considering first 120 and then we consider, let's say, 100. Okay. So now, if that be the case, in the second example, I'm considering my sale consideration as 100. In that case, what will happen if my sale consideration is more than the WDV? So 100 is greater than 70. Right? So this difference of 30 is allowed as deduction initially as depreciation. Now, under section 41, if you read section 41, which is what? Deemed income. What does 41 says? Where any building, machinery, plant or furniture, 41.2 says, is owned by the assessee in respect of which the depreciation is claimed under 32.1.1 on SLM, which has been used for his business, is sold, discarded, demolished or destroyed, and the money payable together with the scrap value exceeds the written down value, so much of the excess as does not exceed the difference between the actual cost and the written down value shall be chargeable to income tax as the income of the previous year in which money becomes due. Are we clear? So what it is trying to say is that in this particular case, if 100 minus 70 is 30, this will be considered as the balancing charge under section 41.2. Now in this case, when it is 120, right? Now 120 minus 70 is what? 50. Right? Now this 50 till the amount that I have claimed the depreciation earlier will be considered under 41.2, which is 30. And over and above that, so this 30 will be taxable under balancing charge. This 20 will be taxable under the head capital gain. Under which section? Yes, under which section?
45.
No, not under 45. This is chargeable under 50A. What is 50A saying? Where the capital asset in respect of which a deduction under 32.1 has been claimed, then the provision of 48 and 49 shall apply subject to the modification that the written down value as defined under 43.6 of the asset be adjusted shall be taken as the cost of acquisition of the asset. So what we will do over here is, here we will consider our sale consideration as 120 less my cost of acquisition will be here what? My cost of acquisition is the written down value.
100.
Right? Written down value 70 plus here what I have considered here is 30, which is taxable under PGBT. So 100 and this will give me 20. So here they are saying that the cost for the purpose of 48 and 49 shall apply subject to modification that the WDV as defined under 43.6 will be adjusted and shall be taken as the cost of acquisition of the asset. Are we clear? Any questions, any doubt? Is this clear, students? Yes or no? Fine. So
Clear, ma'am. Clear.
Yes.
this is about the concept of the power generating units which are there. Okay, one second. Now we move towards the block of asset concept, which is 32.1.2. Now in the case of the block of asset, it is very clear, students, that once the asset goes to the block of asset, it becomes the part of that asset. It becomes the part of that block itself. Now, how will you compute for the block of asset concept? So, for the block of asset, you will start with your opening WDV. You will add the additions during the year. And you will subtract any asset which is being taken out during the particular year. Right? So, and that will give you the closing WDV on which you have to claim the depreciation. Fine. So, we will start with our opening WDV. We will add the additions, we will less the money payable on the asset transfer, and that will give us the closing WDV for the year. Now, where do I get this? Under section 43. So, if you go to section 43, that defines what is the block. So, let us look at it. So, if you see, 43.6 talks about what is the meaning of written down value. It says in the case of block of asset, in respect of any previous year, the aggregate of the written down value of all the assets within that block of assets at the beginning of the previous year. So what I will start with is my opening WDV as on 1/4. Okay. And what do I make? Increase by the actual cost of any asset falling within that block during the previous year. So I will add the actual cost of asset acquired during the previous year. Now I will divide it into two parts. A, which are used for greater than 180 days, and B, used for less than 180 days. Right? Then, by the reduction of the money payable in respect of asset falling within that block, which is sold or discarded or demolished during that previous year, together with the amount of scrap value, if any, however, that the amount of such reduction does not exceed the written down value. So, less money payable on asset discarded, sold, or demolished. So even if you receive any insurance compensation, you will include here, including my scrap value. Right? So this I will reduce it. So this is going to be restricted to the WDV. In the case of slump sale, decrease by the actual cost of the asset falling within that block as reduced by the amount of depreciation that would have been allowed to the assessee as if the asset was the only asset in the relevant block of asset. So in the case of slump sale, what happens is asset gets transferred. In the case of slump sale, the actual cost minus the depreciation allowed on the assets which are transferred to the slump sale. Are we getting it? So this is how I will get my closing WDV, students. Are we clear? So in case of the slump sale, what happens is slump sale is basically the sale of the assets, like undertaking itself, sale of an undertaking without assigning the individual values to the asset. So when I get the lump sum price for the undertaking to be transferred, that is called as slump sale. We'll see in the capital gain class. So this will give me my closing WDV, on which I will claim the depreciation during the year. Fine? Yes or no? Any question, any doubt?
No, ma'am.
Is this clear? Okay. So this is how I will compute my depreciation. Now, this we understood. what is the WDV? We are going to discuss about this in detail also. Okay, so what it is trying to say is that for the purpose of computing the depreciation, this is how I will first start with. Now, what is WDV? Now, we'll divide this into two segments. We'll discuss now what is WDV. So it is saying, first of all, WDV in the case of assets acquired in the previous year. Okay, so the assets which are acquired in the previous year, the WDV is equal to actual cost. The WDV is equal to the actual cost to the assessee. Now students, what is the meaning of the actual cost? What is the meaning of the actual cost? Now this has to be students understood in reference to the common parlance which is there. Okay, this has to be understood how the general meaning is of the term actual cost. So the Supreme Court in the Chellapalli Sugar Mills case, a very old judgment of the Supreme Court, it had held that the actual cost is the cost incurred to bring the asset into existence. Yes, Geet. Cost plus any incidental expense plus whatever it takes, any trial run expenses, less trial run incomes which are there, scrap value which is there, all of that has to be. So the cost here means that the cost which is required to bring the asset into the existence. That is what is the meaning of the actual cost. Are we getting this particular point? So the Income Tax Act here says that the actual cost. But the actual cost has to be understood in the context of like from the perspective of how the commercial man would understand. Let's say for example, if I'm talking about the TV. So is this the price that you actually pay to bring that TV? The answer is no. Your installation charges, any charges for the transportation, all of that is your actual cost, students. Are we getting this particular point? So actual cost here means that the cost which is incurred to bring the asset into existence. Are we clear? Now here if you look at it, the actual cost is defined also under the 41 itself or 43 itself. How is it defined? Let us look at it. So it says, if you look now, actual cost is defined in 43.1. It says actual cost means the actual cost to the assets of the assets to the assessee. So it also says the same thing. Actual cost means the actual cost of the assets to the assessee. Meaning the cost which has to be understood in the commercial terms. Clear? So let's write down. To be understood in commercial sense, cost incurred to bring the asset into existence. The cost which is incurred to bring the asset into the existence. So basically, this will, or to put it into the working condition, or to put it into the working condition. So basically, technical charges, installation, your transportation, all of these costs are incurred. Okay. So actual cost to the assessee reduced by that portion of the cost thereof, if any, as has been met directly or indirectly by any other person or the authority. So what it says is less any cost which is met directly or indirectly by any person or the authority. Now, what does this mean, students? So any cost met directly or indirectly by the authority means waiver of bank loan. Yes. So if there is a waiver of the bank loan, because let's say I have taken a machinery on loan and the bank has waived that loan. So what will happen is, in that particular case, the amount will get reduced from the cost of asset. If the loan was taken not for asset, if the loan was taken for business and it is waived off, then what will happen, students?
Perquisite 28.4.
Correct. Very good. So here, example, you can write waiver of bank loan. Right? If bank loan was not for capital asset, then 28.4. Fine. Now, actual cost means actual cost of the assets to the assessee. Again, let us go back to ICDS 5. What does ICDS 5 says now here? ICDS 5 says it also defines the components of the actual cost. The actual cost of an acquired tangible asset shall comprise its purchase price, import duties, other taxes, excluding those subsequently recoverable, for which you will get the credit, right? Let's say, for example, if you take the mobile phone and you obtain the GST credit, you will get the credit of that GST. Will you capitalize the GST into the cost? The answer is no. And any directly attributable expenditure on making the asset ready for its intended use. Any trade discounts and rebates shall be deducted in arriving at the actual cost. Are we clear? Yes. So let's just write it over here. ICDS 5. Actual cost shall include the purchase price plus import duties, exclude the creditable taxes, right? Then other taxes, right? And any direct expense. any direct expense on making the asset ready for its intended use. Reduce the trade discounts. Right? So what it says is, the cost of the tangible fixed asset may undergo changes subsequent to its acquisition or construction on account of price adjustment, changes in duties or similar factors, or exchange fluctuation as specified in ICDS on foreign exchange. Admin and other general overheads are to be excluded from the cost of tangible fixed assets if they do not relate to a specific fixed asset. So let's say, for example, if you have paid general salaries which are not concerning any particular expense, any particular asset, those are not to be included. Expenses which are specifically attributable to construction of a project or acquisition of fixed asset or bringing to its working condition shall be included as a part of the cost of project or as a part of cost of tangible fixed asset, right? So that we understood that any direct expenses are to be included. The expenditure incurred on startup and commissioning of the project, including the expenditure on test runs and experimental production, shall be capitalized. So you will add any startup expenses, right? The expenditure incurred after the plant has begun the commercial production, that is production intended for sale or captive consumption, shall be treated as revenue expense. So after the commercial production has started, after that you will not capitalize because the plant has come into existence. Clear? Any questions, any doubt till now? Fine. Now, let us go back to 43. It says where the actual cost of the asset, because this is before 1975, where the assessee incurs any expenditure for acquisition of any asset or part thereof, in respect of which a payment or aggregate amount of payments made to a person in a day is otherwise done by account pay check or bank or account pay bank draft, or use of the electronic clearing system through a bank account or through such other electronic mode, exceeds 10,000 rupees, such expenditure shall be ignored for the purpose of determining the actual cost. So basically what we are trying to say here is you have to reduce. So here I am writing less expenses for purchase of the capital asset in cash greater than rupees 10,000 in a day or to a person. Right? So these expenses are not to be capitalized. Are we clear? Yes or no? So these expenses are not to be capitalized. Yes or no, students? So any expenditure in cash is not to be capitalized. Fine. Next, what it is trying to say is, let us read. Where an asset is used in the business after it ceases to be used for scientific research related to that business, and a deduction has to be made under 32(1)(2). So where the asset is used in the business after it is used for scientific research. For scientific research, what does happen when you claim a scientific, when you have expense for scientific research?
100% deduction is allowed.
Correct. So any asset which is purchased for scientific research, you get 100% deduction of that asset. Even though it is a capital expense, but section 35 says you will get a 100% deduction. Now, if after it is being ceased to use for scientific research, use for research. Now, in that particular case, you are using it for your normal business, then the actual cost of the asset shall be the actual cost as reduced by the amount of deduction allowed under 35(1)(4). Meaning you are getting the 100% deduction. So what will be your actual cost?
Nil.
Nil. Correct. So here, in case of asset introduced which was, or you can write in simple words like this, asset introduced on which scientific research deduction was claimed under section 3514. Then your actual cost is nil. Why it is nil? Because you have already claimed the deduction for the same under 3514. Clear? Where a capital asset is referred to in 28(6)(a) is used for the purpose of business or profession, the actual cost of such asset to the assessee shall be the FMV which has been taken into account for the purposes of the said clause. What does this mean, students? Yes?
Capital asset,
Hmm?
capital stock in trade has been converted into the capital asset and it was used for the business purposes. Then the cost will be the fair market value on the date of conversion.
Right. We just now discussed this, right? So in this particular case, if the capital asset, if the stock in trade is converted into the capital asset, in that particular case, what will happen, students, is you will consider the fair market value which is taxed under 28(6)(a). Okay. So this we have already done. I'm just requoting it here. SIT converted to capital asset. Then my actual cost is FMV charged under 28(6)(a). Okay. This explanation 2 is saying where the asset is acquired by assessee by way of inheritance or gift. Then the actual cost of the asset to the assessee shall be the actual cost to the previous owner. Are we clear? So this is in the case of asset acquired by the assessee under gift. So here I am making a separate column itself just to make it easy for you to remember. Actual cost is equal to cost to the previous owner in the case of first is gift or inheritance. Right? Gift or inheritance. Secondly, it talks about where before the date of acquisition by the assessee, the assets were at any time used by any other person for the purposes of his business or profession. And the AO is satisfied that the main purpose of the transfer of such assets directly or indirectly to the assessee was the reduction of the liability to income tax by claiming the depreciation with reference to an enhanced cost. The actual cost to the assessee shall be the amount as the AO may, with the approval of the JCIT, determine having regard to all the circumstances of case. Now, this is, case where, let's say, for example, I was owning an asset, right? I was claiming the depreciation. I am transferring the asset to my, let's say, brother. And I'm transferring it at a higher value to my brother or to any other company that is owned by me only. This is just that now I will be able to claim the depreciation at the higher cost. So this was done to reduce my profitability of the other company. So in this particular case, the AO can decide the amount on his own. Fine. Next is where any asset which had once belonged to the assessee and had been used by him for the purposes of his business or profession and thereafter cease to be his property by reason of transfer or otherwise is reacquired by him, then the actual cost of the asset shall be the actual cost to the asset to him when he first acquired the asset as reduced by the depreciation, or the actual price for which the asset is reacquired by him, whichever is less. So here I am making another column for you now. Which I am writing it as actual cost on notional basis. So let's say, for example, if A is transferring the asset to B and it is reacquiring. So this is transfer, this is reacquire. Then section 43 says what? What will be my actual cost? Which will be lower of A, actual cost paid first minus the depreciation, or B is the actual cost paid to reacquire, whichever is less. So when I am owning the asset and was used for my business, thereafter I transfer it and then again reacquire. So my actual cost for A will be the amount paid first minus depreciation, which is my WDV, or the actual price for which I have reacquired, whichever is less. Clear? Next is where before the date of acquisition by the assessee, the assets were at any time used by another person for the purpose of his business or profession, and he has claimed the depreciation, and such person acquires on lease, hire or otherwise assets from the first person, then in that case, notwithstanding anything contained in explanation 3, the actual cost of the assets which is there of the transferred assets in the case of the first mentioned person shall be the written down value of the said assets at the time of transfer thereof by the second mentioned person. So what it is trying to say is, again this is I am putting it under the notional cost one. So this is the second example. Let's say A is there, right? He is acquiring the asset, right? A is acquiring the asset, but before the date of acquisition by him, the assets were used by B. Right? Assets were used by B and B was using it for his business or profession, and he had claimed the depreciation in respect of such assets. And now B is again acquiring, B is transferred, and A is now not transferring back, he is leasing it out. So A is then leasing it out to B. Then in the case of A, what will be the actual cost? WDV in the hands of B. Right? WDV in the hands of B. Fine. Then this is not applicable. Sorry, this is yeah. Where a building previously the property of the assessee is brought into use for the business or profession, the actual cost shall be the actual cost of the building to the assessee as reduced by the depreciation calculated at the rate in force on the date that would have been allowable had the building been used for the aforesaid purposes since the date of acquisition. Again, this is a case of notional depreciation. So, building used for personal purpose now used in business. Then what will be my actual cost? Will be actual cost minus the notional depreciation till date. Will be notional depreciation will be allowed. Chitra, this is not Stock, okay, yeah, you had answered earlier. Okay. Then where the capital asset is transferred by a holding company to its subsidiary or by a subsidiary to a holding company. In case section 47 is applicable, we'll see 47 in the capital gain. The actual cost of the transferred capital asset to the transferee company shall be the same as it would have been to the transferor company. So here actual cost is cost to the previous owner. In case of transfer of capital asset by subsidiary company to holding company under section 47.4 or 47.5. Right? This we'll see it in the capital gain class. In the case of amalgamation, any capital asset is transferred by the amalgamating company to the amalgamated company, and the amalgamated company is an Indian company. Then the actual cost of the transferred asset to the amalgamated company shall be the cost to the amalgamating company. So this is also applicable in the case of amalgamation. If amalgamated company is Indian company. Next is where in the case of a demerger, the capital asset is transferred by the demerged company to the resulting company, and the resulting company is the Indian company. Then the actual cost of the asset to the resulting company shall be the cost to the demerged company. Are we clear? So this is also applicable in the case of demerger, sorry. But my resulting company should be Indian company. Clear? Now next is, what it says is, it is hereby declared where any amount is paid or payable as interest in connection with the acquisition of an asset. So much of such amount as is relatable to any period after such asset is first put to use shall not be included in the actual cost of the asset. What does this mean? Yes.
After first put to use, whatever the interest that we are paying should not be included into the cost of the asset, and it is an expense. Right up
That
to
means
P&L.
interest up to the
Capitalize, put to use.
point when asset is put to use has to be capitalized. This is what explanation 8 to section 43(1) says. If you read now section 36, deductions. 36(1)(3) says the amount of interest paid in respect of capital borrowed for the purpose of business or profession is to be allowed as deduction, provided that the amount of interest paid in respect of capital borrowed for acquisition of asset for the period beginning on the date on which capital was borrowed for acquisition of asset till the date on which such asset was first put to use shall not be allowed as deduction. So 43(1) explanation 8 is saying after the asset is put to use, you will not get to capitalize. 36(1)(3) is saying you the same thing. Till the time the asset is put to use, you will not get any deduction. So this is also said by section 36(1)(3) proviso. Now let us go to ICDS. Let us go to the ICDS. Which ICDS? 9. Borrowing cost. What does it say? It says borrowing costs that are directly attributable to acquisition, construction, or production of a qualifying asset shall be capitalized as the part of that asset. What is a qualifying asset? Land, building, plant, machinery being tangible asset. Know-how, patents, copyright, trademark, licenses, franchisee, or any other business or commercial right of similar nature which are intangible asset. And the inventories that require a period of 12 months or more to bring them to the sellable condition. In these cases, you have to capitalize the interest. So interest on loan borrowed, which is there, has to be capitalized. Are we clear? This is what ICDS 9 is saying. So let us just write down here. Capitalize interest. Capitalize the interest attributable to the acquisition, construction or production of qualifying asset. Okay? Now, what is the borrowing cost? Here they are not saying the word interest. It is saying borrowing cost. Borrowing costs are interest and other costs incurred by the person in connection with the borrowing of fund and include the commitment charges on borrowing, amortized amount of discounts or premium relating to borrowing, any ancillary cost, any finance charges under the finance lease. Okay. Now, here what they are saying is what is the borrowing cost eligible for capitalization. Now, subject to para 8, the extent to which funds are specifically borrowed for the purpose of acquisition, construction or production of a qualifying asset, the amount of borrowing cost to be capitalized on that asset shall be the actual borrowing cost incurred during the period on the funds so borrowed. So, basically, here what they are saying, if the borrowing is specifically for the capital asset or the qualifying asset, okay? So, capitalize the cost. Okay, capitalize the borrowing cost. However, in respect of borrowing other than the referred to in para 5, which is like general borrowing. Let's say I've taken a business loan. I'm using some part for my fixed asset, some part I'm using it for my business. So in case of the general borrowing, this is not specific. In case of general borrowing, the amount of borrowing cost to be capitalized shall be computed in accordance with the following formula, which is A into B divided by C. What is A, B, and C? A is the borrowing cost, which is my interest. Into B is the average of the cost of the qualifying asset as appearing in the balance sheet of the person as on the first or the last day of the previous year. So, average cost of qualifying asset. C is the average of the amount of total assets of the balance sheet. Are we clear? So this is how the general borrowing cost will be allocated. Are we clear? Any questions? Now what is the commencement of the capitalization? The capitalization shall commence for the specific borrowing from the date on which the funds were first borrowed, and in case of general borrowing from the date on which the funds were utilized. And when will the borrowing cease to be capitalized? In the case of qualifying asset, it is saying when the asset is first put to use. Are we clear? When the asset is first put to use. Any question, any doubt? Clear? Okay. So, this has to be capitalized from my borrowing cost Here from the date of funds borrowed. Here from the date of funds utilized until the qualifying asset is put to use. Are we clear? Any questions, any doubts, students? Fine. Okay, let us go back to 43 then. Actual cost meaning again. For the removal of doubt, it is hereby declared that where an asset is or has been acquired by an assessee, the actual cost of the asset shall be reduced by the amount of excise or additional duty leviable in respect of which a claim of credit has been made under the central excise rule. So wherever there is a credit available, you will reduce that credit. So basically, we will reduce any SENVAT credit. Clear? Where the portion of the cost of an asset acquired by the assessee has been met directly or indirectly by the central government or state government or any authority established under the law or by any other person in the form of subsidy, grant, reimbursement, then so much of the cost as is relatable to such subsidy or grant or reimbursement shall not be included in the actual cost of the asset to the assessee. What does this mean? Yes.
Subsidiary from the government should be reduced from the actual cost.
Correct. So any subsidies, grant which are there, which are given, or any cost which is met by the central or state government has to be reduced. However, it says where such subsidy or grant or reimbursement is such nature that it cannot be directly relatable to the asset acquired, then so much of the amount which bears to the total subsidy, the same proportion as such asset bears to the total asset shall be reduced or shall not be included in actual cost. Let's say I've got some general subsidy which is for asset, which is for my business also. Then I will allocate that subsidy amount into my cost of that asset divided by total asset to get the amount of reduction. Right? So this is similar to this only, which the 43.1 opening portion is saying. Actual cost, which is less any cost as reduced by any cost met directly or indirectly by any person or authority. And here it is specifically saying for subsidy, which is explanation 10 to section 43.1. Now, this, if you remember, we had already discussed. If you recollect here, under 28.4, we were discussing about this. Sorry. What did we discuss? Subsidy. If it is revenue, it is any which is income. If it is relating to capital asset, reduced from the cost of asset as per explanation 10 to section 43.1 and ICD 7. If it is not relating to capital asset, you will consider under 28.4. Are we clear? Yes or no? Sorry. Yes
Yeah,
or no? So this is what you have to remember in respect of this particular amount of the grants which are there. Now, here I would like to make a reference to ICDS 7. What is ICDS 7, students? Government grant. Okay. So let us now make a reference to the ICDS 7 government grant. What does it say? Government grants are basically assistance by government either in cash or in kind to a person for past or future compliance with certain conditions. How do we recognize? The government grants should not be recognized unless there is a reasonable assurance that the person shall comply with the conditions attached to them and the grants shall be received. So basically, when you are getting the grants, you will only recognize when you have the assurity that you will comply with the conditions with respect to which the grant is given. Let's say the grant is given that you will do the project completion in 10 years. Only when there is a reasonable assurance, only then you will recognize the grant. However, the recognition of government grant shall not be postponed beyond the date of actual receipt. So just write down over here. ICDS 7. Government grant. Okay. First is a recognition. Not to be recognized unless there is reasonable certainty for compliance of the conditions, and secondly, grants shall be received. However, no postponement of recognition if there is actual receipt. So on actual receipt, you will recognize. Now this is also in line with which section which we have studied? 145B. Do you recollect 145B?
Yes, ma'am.
Yes. So the income referred to in 224, this is what 18, shall be deemed to be the income of the previous year in which it is received. Are we clear? So the actual recognition will not be postponed unless you and in the year in which the grants are received, you have to recognize it. Beyond that, you can't postpone. Okay. So let's just write it over here. (145B) recognize in the previous year of receipt. Okay. Next one is treatment of government grants. Whether government grants relates to the depreciable fixed asset or the assets of a person, the grant shall be deducted from the actual cost of asset or the WDV which is there. Okay. So how is the treatment here? So if it is directly related to the depreciable fixed asset, reduce from actual cost or WDV. Okay. Where the grant relates to a non-depreciable asset, then the grant shall be recognized as income over the same period over which the cost of meeting obligations is charged to income. So where it is related to the depreciable fixed asset, then you will reduce from the actual cost. Okay. Secondly, if it is related to non-depreciable fixed asset, then when do you recognize? You will recognize on the pro rata basis. Over the cost. Okay. Now, where the government grant is of such nature that it cannot be directly related to the asset acquired, then so much of the amount which bears to the total government grant, the same proportion as such asset bears to the all the assets with reference to which the government grant is so received shall be deducted from the actual cost of asset or the WDV. So basically, where it is a general grant. Right, which is not specifically towards one asset. So total grant into depreciable fixed asset upon the total asset. This you will reduce from the actual cost or WDV. Where the government grant is receivable as a compensation for expenses, right, incurred in the previous year or for the purpose of giving the immediate financial support to the person. This shall be recognized in the period in which it is received or receivable, right? So where, let's say, for example, this is not in relation to any asset. This will be considered in the year in which it is received. So let us write it. If it is some financial assistance, then in the previous year of receipt. Where the government grant is other than the covered by para 5678 shall be recognized as income for the over the period necessary to match them with the related cost. So any other government grant which is there, you will match it with the cost. And the government grant in the form of non-monetary assets shall be accounted on the basis of their acquisition cost. So, many times the government gives you the asset itself. So you will recognize at the cost at which you have received the asset. So if it is non-monetary grant, then the acquisition cost. And if the government grants are refunded, then to the extent the amount of refundable credits are there, that shall be charged to the P&L account. And if it is relating to the fixed asset, you will actually add back the cost of the asset. Are we clear? So if it is refunded, government grant, then add to the cost. Are we clear? Any questions, any doubts, students? Yes? Are we clear?
Yes, ma'am.
Ma'am,
Okay?
if,
Yes.
ma'am,
Yes, clear.
if non-monetary grant is given at free of cost, then the acquisition cost will be nil, right,
Zero.
ma'am?
Yes.
So
Then it
we
will be
will
zero.
it will be zero, will be recognized at nominal value.
No, it will be zero.
Zero. Okay.
Fine. So again, coming back to my 43, let's see what is left out under this. Okay. Next is where an asset which was acquired by an assessee being a non-resident is brought to him by him to India and is used for the purpose of business. The actual cost of the asset to the assessee shall be the actual cost as reduced by the notional depreciation calculated at the rate in force as if the asset had been used in India. So what we will do is we'll again go back to the notional basis. So for any imported asset, it will be actual cost minus the notional depreciation. Are we clear? This is in respect of where the asset is acquired by the assessee in the scheme of corporatization of recognized stock exchange. So many times these recognized stock exchange are constituted as AOP, but if they get converted into the company, then the actual cost of the asset shall be deemed to be the amount which was the cost to the previous owner. Are we clear? And the actual cost of the asset on which deduction has been allowed under 35AD. 35AD is what?
Specified business.
Specified business, yes. So if you claim the deduction of 100% under 35AD, the actual cost shall be treated as nil. Are we clear? Yes or no? And in that particular case, the actual cost will be considered as 0. Clear? Yes or no? So here you can write. But let's write this, when we will do the 35AD. Okay? So any questions, any doubt till now with respect to the actual cost? Fine? Yes? Is this clear till now, students?
Clear,
Yes,
ma'am.
Okay. Now we'll move towards the WDV again. So we have seen the WDV in the case of assets acquired in the previous year. In the case of block of asset, we have seen. Okay. This is not applicable because this was there in the earlier act. Okay. Where in the case of succession on business or profession, an assessment is made on the successor under 170. The written down value of the asset or the block of asset shall be the amount which would have been the written down value if the assessment had been made directly on the person succeeded to. That is one. In case of succession of business. So written down value for the successor shall be written down value for the predecessor. Similarly, where in any previous year any block of asset is transferred by a holding company to a subsidiary company, or by subsidiary to the holding company, in which 47.4 and 47.5 conditions are complied with. We'll see that in capital gain. Or by the amalgamating company to the amalgamated company, right? Then the actual cost of the block of asset in the case of transferee company or the amalgamated company shall be the WDV in the books of the amalgamating company or the transferor company. So this is very, very important in the case of, see, we have seen this in the case of the actual cost. We have written it, right? Actual cost will be cost to the previous owner. In the same cases, in case of the transfer of capital asset by holding to subsidiary or vice versa, in case of amalgamation, in case of demerger, and in case of succession. Similar will be for the WDV. Actual cost is for the asset acquired during the year. WDV is for the asset already in existence in block, right? So again, in the case where the block of asset is transferred by private company to or unlisted public company to LLP on the conversion of private company or unlisted public company to LLP. In that case also, the actual cost of the block of assets for LLP shall be the WDV for the private limited or unlisted company. Same is again in the case of corporatization of stock exchange. If it was AOP, then it will be WDV as in the books of the AOP. Right? So in that particular case here, this is similarly applicable in the case of WDV also. So WDV in the books of transferee is equal to WDV in the books of transfer. Same is in the case of demerger also. So where it says where the block of asset is transferred by demerger to demerged company to resulting company, then for the resulting company, the WDV will be the WDV to the demerged company. Are we clear? Yes or no? Any
Yes, ma'am.
question, doubt? So this completes your depreciation as well. There is one last point left which we will do in the next class, which is in pertaining to the foreign exchange. So that we'll take care in the next class. But with this, we are completing our depreciation. In the next class, we'll complete section 43A, which is in connection with the foreign exchange asset. And then we will start with the disallowances, student. Okay? Yes or no?
okay, ma'am.
Okay? Yeah,
Okay,
so
ma'am.
you will revise this thoroughly. Yes, we'll also do the additional depreciation in the next class. There's some portion which is still remaining, and then we will move to the allowances, disallowances. So our next lecture will be dedicated towards the allowances, disallowances, and after that we will have one more lecture which will be dedicated towards the specified business deductions, sectoral based deductions, and we'll allocate some portion towards the this 44A, 44AB tax audit and all of those sections, presumptive. Fine. So you will have to revise this very thoroughly. This is very, very important. Start solving the questions from your module also. And let's discuss everything in the next class. Thank you so much and a very happy Independence Day to all of you in advance.
Same to you. Thank you.
Thank you, ma'am.
Thank you. Yeah. Yes, session over.
अशोक जी सेशन ओवर। हाँ जी हाँ जी। अशोक जी एक सेकेंड। हेलो, अभी लाइव है शायद। हम्म। जी